gas prices might be about to go up. And if that happens, it could affect your rent, your mortgage, and even home prices. But the reason might surprise you. It has to do with the war in Iran and one of the most important shipping lanes on the entire planet. So if you own property or plan to buy one someday, share this video, because this is one of those global events that quietly affects the housing market. Let's break it down. Right now, there's growing military conflict involving Iran, Israel, and the United States. There have been missile strikes, drone attacks, and military operations across the region. And because of the current conflict, shipping through this area has slowed dramatically. So what exactly is the Strait of Hormuz? It's a narrow waterway between Iran and the Arabian Peninsula. It may not look important on a map, but every day under normal conditions, about 20 million barrels of oil pass through that corridor. That's roughly a quarter of the world's seaborne oil supply. So when military conflict threatens that route, global energy markets pay attention immediately. Now here's something interesting. The biggest issue right now is not a physical blockade. The bigger issue is insurance. Shipping companies need marine insurance to move cargo. But when missile attacks, drone strikes, and military threats increase, insurance companies pull coverage. Without insurance, ships don't sail. So technically, the route still might exist, but if ships can't get insurance, traffic collapses. Analysts sometimes call this an insurance-driven shutdown. So why should homeowners care? Because oil markets are global. If supply becomes uncertain anywhere in the world, prices move everywhere. And when oil prices rise, gas prices usually follow. Even small disruptions can move markets quickly because traders begin pricing in risks. And right now, the risk is one of the world's largest oil corridors. But higher oil prices don't just affect gas. They trigger a chain reaction across the entire economy. Energy gets more expensive, transportation gets more expensive, shipping gets more expensive, manufacturing gets more expensive, and eventually those costs show up in consumer prices. But there is one industry that is especially sensitive to energy prices: real estate. Real estate depends heavily on energy. Construction equipment runs on diesel. Materials are shipped by truck. Factories use energy to produce building materials. And even something simple like roofing materials or concrete requires large amounts of energy to manufacture and transport. So when oil prices rise, construction costs often rise too. We saw this happen during the pandemic. Energy costs went up, supply chains tightened, shipping prices exploded, and suddenly building homes became much more expensive. That reduced housing supply, which pushed housing prices higher. So when analysts watch oil markets, they aren't just watching gas prices, they're watching housing supply risk. Because if construction becomes expensive, builders slow down, developers delay projects, and some housing developments become financially impossible. When fewer homes get built, supply tightens. And when supply tightens, prices can rise. That's one reason housing markets can stay strong even during economic uncertainty. But there is another layer here. Energy shocks can also affect inflation. When fuel costs rise, shipping costs rise, production costs rise, and inflation tends to follow. And inflation affects something extremely important to housing: interest rates. Mortgage rates don't only move when the Federal Reserve acts, they also move based on inflation expectations and bond markets. If energy prices push inflation higher, investors may demand higher yields, and that pushes mortgage rates higher. So something happening thousands of miles away can actually change the cost of buying a house in the United States. This is how global economics work. A war happens overseas, shipping lanes get disrupted, oil prices move, energy costs rise, inflation costs rises, interest rates react, mortgage rates move, housing supply changes. But let me be clear about something. Events like this do not automatically crash housing markets. Sometimes they do. Sometimes they do the opposite. If construction slows and fewer homes get built, housing supply tightens and prices can stay strong. Real estate is complicated like that. So, if you're a homeowner or a real estate investor, there are a few indicators worth watching. Gas prices, oil prices, mortgage rates, construction activity. Those signals often tell you a lot about where the housing market might go next. The big lesson here is this: real estate doesn't exist in a bubble. It's connected to global economics, energy markets, shipping, war, supply chains, interest rates. All of those things shape the housing market behind the scenes. Sometimes the events that affect your mortgage starts in a place most people never even look at, like a narrow shipping lane halfway around the world. Now, if you found this breakdown helpful, share this video, because most people never hear how global events connect to the housing market. And understanding the bigger picture helps people make better financial decisions. Thanks for watching, and I'll see you in the next one.